Good afternoon, everyone. If you are hearing me, let me know in the Q&A box. We're going to use the Q&A box today. My name is Brian Overby. I should introduce myself. I am the uh, Senior Options Strategist for Options Play, and I'm filling in for Tony today. He is traveling. Today's seminar is going to be on cash secured put selling, and it's part of the Options Play education portfolio. It sounds like everybody is hearing me all right and you're using the correct box. If you can use the Q&A box, that would be great. And you can put any questions in during the show and I will try to address all those questions. Once again, my name is Brian Overby. I am the Senior Options Strategist for Options Play, and I'm the author of a book called The Options Playbook. And you can check out the website at optionsplaybook.com. All right, so let's jump into it. This is going to be about a 45-minute presentation. And like I said, I'll take any questions along the way. You can put them in the Q&A box. The presentation is set up so that it will address most questions as we go. And then also, if we get to a point, we will try to use a couple of real life examples, but the PowerPoint uses the Options Play platform to try to come up with a specific scenario of strategies and how to use cash secured puts. So with that said, we have a disclaimer. Nothing that we use today, even though it's going to be real securities, is meant to be a recommendation. Past performance is not a guarantee of future results. All right. My goal here is to come up with a simple strategy to generate weekly income using option contracts. Now, if you do the wheel strategy, which you may have heard of or may not have heard of, it's a strategy where you're selling a put option, which gives you the obligation to have the stock put to you, and you get paid for saying, I will buy that stock. And once you get the stock, then you go out and say, okay, if the stock goes up, I don't mind selling it. So you sell a call option to bring in cash to get paid for saying you'll just sell the stock at a higher price. To start with, we need to identify some stocks to sell options on with clear rules as to when to enter a trade and which options to sell. And it requires passive management. It means that it's not a buy and hold strategy. It's going to tame the volatility of the marketplace. As a matter of fact, a lot of people that will do this strategy, their main goal is to bring in income above and beyond any dividends a stock might pay, and make your money through that income more so than the capital gains on the underlying stock. So if you get the strategy set up right, that is definitely a possibility that you might make more from the premium or the prices received from doing the short put selling and the short call selling than you do on the actual gains and losses on the underlying stock that you are trading. So, who is this webinar for? Well, people that like to buy stocks. That's simple. So, if I were to title this webinar, my title would have been Options for the Stock Investor. And this strategy, selling puts to buy stocks, in particular, the main focus of the webinar today, is probably the most popular strategy that I've ever seen done in option contracts, and I've been doing this for over 30 years. There are many people that just have never bought an option contract. They like to buy stocks and they like to use options to enhance that portfolio. And it's that simple, that straightforward. Now, you can do some of this for speculation, and some of the rules will apply, especially when it comes to just picking stocks that you want to do this strategy on. But so in general, let's go through the bullet points here first. Most investors keep the majority of their wealth in longer term equity investments. So this is a great strategy for an IRA. If you have an IRA account and you have clearance to trade options in them, selling a put to buy a stock at a lower price is not much different than putting in a limit order, and we'll go into a little bit more detail on that. Purchasing securities for your portfolio that can generate upwards of a 5% yield in a single month. That has everything to do with the premium. We'll show you how we're picking those. And requires a few simple rules to achieve a consistent income goal. All right, so what is a short put? Well, a lot of people are confused by the terms put and call. A call means that, and here's the main reason why. Let me step back for just 1 second. Why this can be confusing is a lot of people always think of options from the buy side of things. They don't think of options from the selling side. And there's a lot of synergies between the option trading world and the insurance world. If you think about it, when you pay for a call option or a put option, you are paying the premium. That's the vernacular from the marketplace. If you buy car insurance, the insurance agent calls up and says, your premium is this amount. And when they determine the amount of that car insurance premium, guess what they do? They send it to an underwriter. If you sell an option contract, what are you considered? You're considered the writer of that option contract. So if you come at options from what they're first intended to do, be to protect an asset, it helps a little bit to understand why a put is called a put. Because if you sell a put, that allows somebody to put stock to you. You take on that obligation. If you sell a call, that allows somebody to call stock away from you. So if you think of it from the side of the seller, the terminology, the put and the call, makes a lot more sense than trying to approach it from the buyer. All right. So on a short put, we can sell it on a stock or an ETF. Now, I liked, as a beginning trade, I like ETFs. ETFs have more stocks in them. They usually track indexes. And one of the most popular ones is the SPY that tracks the S&P 500 index. But then you get some volatility with some predictability, right? With an index, you don't get the huge gaps up and the huge gaps down. So if I'm a beginning option trader and I'm trying to set up my strategy, let's call it the wheel strategy, it's not a bad place to start with ETFs. Also, inside the options play platform, we look a lot at stocks. So you want something where you get a little bit of premium, you get a little bit of volatility in the underlying stock, because you want to get paid for saying you will buy this underlying stock at a lower price. And volatility helps that. But you also don't want it to be too volatile that you can lose your shirt, right? Because the stock has a huge gap up or a huge gap down. Okay. So we receive the put premium as yield on the cash assets side to purchase the securities. This creates an obligation to buy the stock or ETF at a specified price. They can put the stock to you. So if you buy stock outright, and I'm just going to draw it with my mouse here. If you buy stock outright, you have unlimited upside potential and substantial downside potential. Now, if you do a put option, that's also the case. You're trying to buy the stock, just like you would if you put a limit order in on the underlying stock. But the break-even price moves down because you actually get paid for saying that you're willing to buy that stock. So if I look at it, if my goal is to buy 100 shares of Chewy, CHWY, that is the pet store. It's trading at $23 a share. And now there's a reason why Tony chose Chewy, is that $23 and, well, here's the actual price, $23.99 is it's easy to be able to buy 100 shares of this. So if you're thinking of a basic option trader, and you're selling the 23 strike put, you take 100 times 23, and that means the cost to buy this put option, the maximum that you would need in your account to buy it is $2,300. So there is a benefit to lower price stocks, and a lot of ETFs keep their prices, exchange traded funds that track industries, right around this level, and it has a lot to do with that. To be blunt, it's just simple to be able to buy 100 shares of it, and people like that. They like that ability. So if we're buying a stock with a limit order, we're going to say Chewy's at $23.99, and we say we want to buy Chewy at $23 a share. Our risk is 23 times 100, or $23, $230 total if the stock went bankrupt. And in this instance, our reward, because we have a price target of $30, is going to be from 23 to 30, which is $70. Or in this instance, we're trying to make $70 per 23 to, it would be $7 per share, not $6 per share. All right. And then if we sell the put option with the short put, and this is our goal, this is the way that we're trading. We have our target where we want to buy, and we have our target where we want to sell. So if I look at this scenario, and we sell one Chewy 23 strike put. Okay, so now we're saying the same thing. We wouldn't mind buying Chewy at a lower price at $23. But now we're saying that we wouldn't mind buying Chewy, but we want to get paid for buying Chewy. So we sell this put at $1.50. We bring in $1.50 worth of premium by selling this put option. That's $150 for every put option that we sell, but we have to be prepared to buy 100 shares of the underlying stock at $23 a share, which is the same way that we would approach it with that limit order. So if we do that, now our risk is reduced. We can say that we're going to use this cost basis to help pay for the stock. So instead of being $23 a share, we're now going to be $21.50 a share. 23 minus the 150 equals $21.50. So now in this instance, if you're at, our goal is to sell the stock at 30 minus $21.50 means our max upside is $8.50 on that trade, or $85 for every 100 shares that we buy. So now here's the difference. And here's the difference between this profit and loss graph and this profit and loss graph. And that our break even here, if we buy the stock, is at 23. Our break even here is at 23 minus 21.50. Now, the good news is that if the stock continues on up, I still get paid for it. Now, I missed out on an opportunity. I thought our buy target was about $23, but we wouldn't have bought it here in this scenario either. And the stock goes up, the put would expire worthless, and I could make that $1.50 on my trade. I didn't get the opportunity to buy the stock, and the stock is now going up. So there's a good news, bad news scenario here, but at least I received something for doing that trade. So if you're looking at doing short puts, a lot of times, a lot of people will look at about a 30 days to expiration or within, especially with the advent of weeklies. Some people like to look at the weekly expiration. Now, if I'm selling this, and inside the platform I highlight the fact that there is a delta on that position, and the further that you go out of the money, the lower the delta will be, and the lower the amount that you bring in will be. So with Chewy at $23.99 in this scenario, the 40 delta would collect $1.50. That's the 23 strike. On a yield basis, that means if you bring in $1.50 on a, let's just round it off and call it a $24 stock, you're going to be bringing in about 6.5%, a little bit more. Now, if you think of that on a dividend basis and you just think about yield, well, that's amazing, right? If you're doing any type of dividend portfolio, any yield between 1 to 5% is an amazing yield relative to the market. In this day and age, though, you're actually getting that type of yield in the treasuries. But with that said, that's a very solid dividend yield, and we're getting that from selling one 30-day put option. Now, if you don't want the stock as bad and you go down a little bit more in the price, you can go down to the 30 delta and bring in $1. Now your yield is $4.66%. And then once again, you can go down a little lower, and we look at the 20 delta, the 21 strike call, and that yield is 3%. So all of what we're just highlighting here is that if you're comparing this to a dividend, selling put options and the premium, just saying that you're willing to buy the stock at a lower price adds a lot of yield to your portfolio. And Chewy is just a great example. Lower price stock that has decent volatility, a little bit of predictability. It's not like it's a pharmaceutical stock, right? It's in the retail space. And because of that, you get decent yield for saying you just want to buy a stock at a lower price than where it's currently trading. Okay, so by doing this too, you also have theta. Theta is time decay. If I sell shorter dated option contracts, the theta, the amount of decay relative to the price of the option contract will increase. On a percentage basis, shorter term options decay at an accelerated rate. The change in the value of an option with respect to time, you can call it theta. I just like to call it time decay, especially when I'm talking about just a simple trade. And in my mind, this is a simple trade to just buy the stock at a lower price by selling that put option. Now, once it gets in the money, then the time value of decays faster as we get to the expiration. But once we get in the money, that option contract then has intrinsic value as opposed to time value or extrinsic value. And then that means that you would be buying the stock at the lower price, at the strike price, than where it was currently trading when you put the trade on. You collect more income selling 4 weekly options than 1 monthly option. And that's all because of the time decay, the fact that you can get some premium. It takes a lot more maintenance to maintain, but that last week is where you get that huge amount of time decay. So on the curve, on the option trading time decay curve, if you sell 4 weeklies, you're going to make more than selling 1 monthly. All right, there's some trade-offs there. Okay, so short put outcomes and management. So here's where Chewy, if it's above 23 at expiration, the put expires worthless. We keep the $1.50 of premium. And if I'm doing a short put strategy, I'm usually going to sell them closer to the money, closer to where the underlying stock is trading, as opposed to the other options that we talked about that were further out of the money, mainly because I'm saying I want to buy the stock. And that's why I'm doing this trade. So I want to be closer to the strike. One, I get more premium, I get more time value, because I'm saying that I will buy it at a price that's closer to where the stock is currently trading. And on top of it, I might get put the stock, right? As opposed to the missing out on an opportunity to buy the stock that I'm bullish on. Okay, keep 150 of premium. If it's above, you may miss out on on upside, and that's true. But just like if you put in that limit order, it's not much different. And you can sell another put. So once this expires worthless, one of the beauty about this is that you can go on out and sell another put. And if you missed out on it a little bit, well, maybe you sell a little closer to the strike. Maybe you sell a little bit shorter time premium because you want that stock to come down within that range and get put to you sooner rather than later. Okay, if it goes below 23, you're assigned, you own stock at the strike price minus the premium received. And in our case, that was $1.50. So we own it at 21.50, which is 6.7% below where the stock was when we decided to buy the stock. All right. Now, don't forget that we're doing this on a cash secured basis. So if I have to buy that at 21.50, you take that and you times that by 100, and you're looking at $2,115 to be able to buy 100 shares at 21.50. And you're going to have that cash to be able to do that in your account. Okay, so here's the challenges. You want to select stocks that meet your investment criteria to purchase for a short put. Managing short puts, if the stock rises quickly, the maximum gain is generated. And that is an issue. I think that's my biggest issue with a short put is, as opposed to a limit order, is that you can't change it as quickly, right? If I have a limit order in saying I want to buy the stock at 23 in our Chewy example, and the stock starts rising and I miss out, right? I'm going to get paid on my short put. But to move that limit order up is very simple. You just cancel the order and move it up inside the First Trade platform. So very, very simple, very straightforward to chase after the stock if the stock is running away from you. But with the put option, you'd actually have to close out the 23 strike and then roll up to a different strike and come up with a different expiration. So you just can't move as quickly if you're thinking about doing the short put. So that is a challenge to me, and that is, you're more apt to just let the short put expire and keep the premium. But you always got to remember here, the way that we're approaching this is that you really do want to buy the underlying stock. You are bullish on it. All right, determining what to do with the stock that drops substantially. Well, that's the same issue that everybody has if you are owning a stock. If you own a stock and it goes down, what do you do with it? Do you buy and hold? Do you buy more? Dollar cost average into the stock? All of that can be done with the short put. So I'm just approaching it the same way as if I own the stock outright. All right. So inside the options play platform, which you all have access to, there is a short put ideas calculator, I guess. I'm not, or scanner is the word that I wanted. I'm struggling with that. Okay. And in this instance, this is how Tony found this scenario. He actually sold, went to short puts, put in yield, and then said, I want something that has some yield and has a lower price stock so that I can buy this underlying stock. And basically by saying this, what you're saying is, once again, that phrase that I've been using all throughout this event is, I want some volatility with some predictability. And I think Chewy is just a great stock in that range, in that you are in the retail space. It's not anything, it probably moves around earnings. Every once in a while they'll announce sales, but Chewy isn't anything that normally is going to get blindsided like a biotech stock that is, or a pharmaceutical stock where you're talking about new products that are coming out all the time and potential lawsuits just in general. This has some volatility and some predictability. What does that translate to? A decent amount of yield. That simple. And I see Sandra actually had a question, and I think it's very pertinent before I keep moving along. It says, can you elaborate a little bit more about you will earn more by trading 4 times in a month as opposed to trading one monthly option contract? And I do think, Sandra, that we have a slide on that. No, we don't at this point in time. But here, let me pull up the options play platform. And I have it right inside this PDF here. And one of the ways that I can show this is we got short puts and we have yield. Let's look at Coinbase. Okay, so this is live markets, real-time quotes right here. Market closes in 3 hours and 34 minutes. So I just went into ideas. I hit this drop box and hit, these are the other ideas that are available, but one of them that is offered is short puts. And when you do that, we're going to do this and we're going to sort by yield, the amount of return that I can make on by selling this 30-day option contract. So if I click on this, it actually puts Chewy into the options play platform and it gives you a potential trade. So in this instance, if we hit click trade, and I'm going to click trade just to get the price and everything. So if we sell the November 29th 210 strike put, oh, this is because we're in Coinbase. I was thinking Chewy. All right, if we sell the 210 strike put, and okay, so let me give you a little bit of background on Coinbase and why I picked it, and then I'll address your question, Sandra, and I'll get into more detail by looking at different expirations and different values on these option contracts. But Coinbase is a play if Bitcoin stock has been a real mover recently, right? Coinbase is the marketplace for a lot of the cryptocurrencies. It's a fairly decent, well-run exchange, and if you're saying you want to buy Coinbase, it usually goes hand in hand with Bitcoin and the other cryptocurrencies. So if they're doing well, usually Coinbase does well. Even though it's independent, it's a marketplace. It's not directly correlated with Bitcoin or any of the cryptocurrencies, and they trade other things. They have a little bit different things to do too. But here's a great example. We can get $16 worth of premium, but we have Coinbase trading right now at 217. So you're saying if it comes down to 210, which that means you got to put up some real money, 100 shares, 100 times 210 is $21,000 minus that premium received. So right here, the midpoint on this is $16.80. So we're bringing in $1,680 per every option contract that we sell. So $16.80 times 100 means that we bring in our reward right here, and we're highlighting it for you, is $1,680. Okay. Little bit more volatility than I guess I would normally want, but if I see this premium and I do want to get a position in Coinbase, you're really getting paid. You're getting paid extremely well for saying that you would buy the stock at a lower price. This expiration has 30 days. DTE stands for days to expiration. And if we change this up, and let's go back and let's look at this. So for 30 days, I'm going to write this down, 1680. And let's look at a shorter term option, and you'll be amazed how sticky the premium is. There'll be a lot more premium on a 1 week option contract. So let's adjust this, go back, and we're going to modify this trade. So the expiration, let's go out 9 days, November 8th. And we'll say with that 210 put. So for example, now let's trade it. Now we're talking about $11.55, Sandra. So in this instance, if you do that, that's 9 days. Okay, so 30 divided by 9, that means you could sell, let's call it just 3 of these puts. In the last 9 days to expiration in this example, you would if you could sell 3 9-day option contracts at $11.55 times 3, you're looking at $34.65. This is an extreme example, especially because Coinbase has a little bit higher implied volatility, and it basically brings in a little bit more premium. So if I sell every week and I do this trade and I manage it to that extent, I'm bringing in a lot more premium, because in the last 9 days to expiration is when a lot of the time decay hangs around. So if you want to get really technical about it, options decay at the square root of time, which means that the curve, if you look at it, is going to go like this. So the more and more as expiration approaches, theta becomes a higher percentage of the price of the option contract. The way that I like to say it, that I think is in the more understandable way to say it, is option prices are sticky, right? It takes a lot to extract that last dollar out of an option contract, even if it's way out of the money, because there's still some perceived risk by the market makers whenever they are selling these option contracts, if you will, is another way to say it. So there's a great example. So let's go down. I don't like UVXY. That's on. Let's see what else. See if there's a symbol in here that the scanner came up with of another stock. Rivian is Rivian is a SG. SG is not bad. Let's look at SG. But Rivian is a EV play. EV play. So Sweet Gardens, okay. Sweet Green Incorporated is, you know, once again, a stock that's not going to have a ton of volatility, and it's a $10 stock in this instance. So it's not bad. It's a liquid underlying. It has a little bit of premium in it, but now you're going from a $210 stock all the way down to a $15 stock. And let's look at the difference in the premium here too. So once again, highlighting high yield. Strike is, in this instance, is, oh, we're selling the 15 strike put on. Let's adjust that. Let's trade. Let's modify this. Still a lot of premium in it. And let's go down to, if the stock is at 37, we'll look at a 35. So that's $2.45. A little bit more realistic in this scenario. So if we trade this, the November 15th the strike is 35, $2.45. Okay, so you're bringing in $2.45 on a stock that is trading at $35. Still a very good, very high premium. This is for 16 days. Let's go the opposite way. So this is 16 days to expiration, and we're still getting that premium, $2.45 with 16 days. Let's double that now. Let's go on out and look at a 30-day option contract, and let's compare that. And I'm doing this off the cuff here, so I apologize if I'm a little bit disjointed. We got to look at a 51-day. Okay, so 51-day. So 651 divided by 16. You're looking at three. Once again, you could do it 3 times in that instance. It doesn't appear there's weekly strikes. So we trade this, and now you're looking just at a premium of the 35 strike, 51 days to expiration is $3.35. Okay, so you're talking $2.45 for 16 days. You could do it 3 times, as opposed to going out to 51 days. And you receive $3.35 for that strike. I think that kind of emphasizes it, Sandra. Does that kind of clear up the point? And I see there's a few more questions in here. Okay, so William asks, and I got another couple of questions that I have to address here. Okay, so with William, you don't quite have it correctly. Okay, so William asks, if I understand correctly, if I had 100 shares of Microsoft, I could sell puts against that 100 shares versus having to put cash aside. No, that's not true. William, the way that we would approach this is that I'm selling a put saying I want to buy 100 shares of Microsoft. So let's put Microsoft in here. Now, Microsoft is going to be very expensive because they're announcing earnings. MSFT. 1 second. So earnings brings in risk. Earnings brings in volatility. So there's going to be a lot of premium on Microsoft because they're announcing after the close today. I'm pretty sure it's after the close. All right. So if I owned 100 shares of Microsoft, I would want to sell a call against it, saying that if the underlying stock went up to my strike price, you could call the stock away from it. If I do not have 100 shares of Microsoft, that's where the cash secured put would come in. So we would modify this trade, and let's not go out 51 days. We're going to go out 9 days because there's going to be a lot of premium. Microsoft is a very expensive stock, and I should equate that. If you think of let's go all the way back to the beginning, and you just think of option pricing. And I talked about the fact that they're the insurance products and a lot of the vernacular that's in that. If you are if you're buying car insurance, is it going to cost you more to buy an insurance policy on a Bentley versus a Ford Taurus, right? The difference in the cost of the underlying is definitely going to affect the car insurance premium. If you think of options as what they were first intended, right? They're more insurance products that are being sold by someone else to protect an asset, that, i.e., if I sell a put and you buy that put, you have protection to the downside, okay? Then the more expensive the underlying, the more the stock could go down. Microsoft can go down $436 in theory if it went all the way down to zero, versus SG that can only go down $37. So just the fact that Microsoft is a $436 stock means that you're going to have higher premiums in general. And then we're going to throw in the fact that there's a known event. There is an earnings report. Once again, let's go to the insurance world. If you were in Florida, and I hope that everybody's doing okay down in Florida, but you had Hurricane Milton coming towards your shores, if you were trying to buy homeowners insurance, it's very hard to do once the forecast is that there's going to be a hurricane hitting the shoreline within the next 4 or 5 days. Well, I know this is an extreme example, but in the options trading world, the best example of a hurricane can be earnings, right? That can create a lot of that volatility. So around those known events, options become pricey, and it's the risk is relative to what's going on in the marketplace. This is when stocks usually move, especially stocks like when we look at Chewy. Chewy is a retail stock. Microsoft might move at any point in time because AI is out there. It's in the news all the time. Chewy's a retail stock. It usually moves around sales announcements and around earnings, and that's when that underlying stock moves. Okay, so that was a little background on pricing, and I'm going to come back and actually do a seminar based off of pricing. But if I'm doing this and I want to own Microsoft, my trade would be, I'm going to modify this, is I want to sell there we go. I want to sell a near term. I'm only going to go out 9 days put option. The stock is at 436. Let's go in and look at the 430. Okay. We can even go lower than that because it's a $400 stock on a percentage basis. That's not that. That's not that much lower than where it's currently trading. 430. Oh, that's why 430. I went to 330, 430, $15. Let's go down to 425. That would be 10 points below. On a percentage basis, not much. Okay, and then we're going to sell the put. It's got to be a trade. Let's modify this. And do this again. 430, $10. Okay, and trade. So now here's what I would be saying, William. I'm saying that the stock is at $4.35. If the stock after earnings comes down to 435, I would be willing to buy 100 shares at 435 minus the net premium brought in. So I want to have at least $43,500 in my account to put this trade on, because I'm saying I'm willing to buy 100 shares of Microsoft if it is put to me at $435, with it trading at $436 in this instance, right? And by saying that, we have 9 days to expiration. If earnings comes out, I'm actually going to be buying the stock at 435 minus that premium received. And I'm going to say, well, I would probably say it's here on the midpoint, but they're saying $10.85. I'll leave it there. I'll leave it at the price inside the platform. So 435 minus 1085 equals at $424.15. So if the stock comes down to below my strike after this earnings announcement, and I get put the stock at $435, I get to keep the premium. If you think about it this way, right? When you sell something, usually you keep the premium no matter what happens with whatever you sell. If you sell a car to your neighbor, you get that cash. You can go out to dinner. You get that cash. You can do whatever you want with it. You don't need to warranty the car and hopefully they want it and they don't want to return it. That scenario, right? You get that cash right away. So if that underlying stock comes down to the strike, I get that cash. I can spend it to help buy the stock. So my break even then is going to be 435 minus $10.85, or $424.15, for just saying I'll buy a stock at a lower price than where it's currently trading. And especially if I'm doing this around earnings, this is if I want to own Microsoft, this is not a bad way to do it, right? But now with the earnings, you could get a gap down way more than 10 points, right? It could potentially go down 30 or 40 points. So hence that's the risk of the earnings and why you get a good amount of premium around an earnings date. All right. Can you explain the risk? Okay, from anonymous attendee, the risk is stock ownership. That's simple. You buy 100 shares of Microsoft at 435, 436.60, where the market is at right now, highlighting it on the screen, at 436.60. Guess what your risk is? $436.62. That is your risk. That's how much money Microsoft is probably not going to go bankrupt at any point in time. But if you buy the stock right now and you buy 100 shares of it, you have $43,662 of risk. That is the same thing with the put. But my risk is reduced by the premium that I brought in. So in our instance, if we do the put, we still have stock ownership risk, but it's minus that net premium, because they're saying you can put the stock to me at 435. If the market goes down and I buy it, I still get to keep the premium, which is $10. It's saying $10.85, right? So 435 minus 1080, we're at $42,420 of risk, and that's my risk. It's my risk, stock ownership. So this is why I started this presentation by basically saying options for the stock investor. If I didn't own any Microsoft and I wanted to own some Microsoft, to me, this is a valid way to say I will buy Microsoft and then hold it for the long term if I want to. If I want to complete the wheel strategy, I come out, I buy this underlying stock, and I say, well, if Microsoft goes up 10%, or 15%. I will then do the opposite side and I will sell a call against the position that I own, which is covered call selling, which I'm sure we already have a presentation on. But that's the second step in options for the stock investor. Sell a put to buy it, sell a call to get rid of it, receiving premium and high yield on a weekly or a monthly basis. It's up to you. In this example, I may not be understanding correct, but we'd be paying 1080 if we bought the put to open. Oh, that's right. It's bought to put to open. That's why it's telling me the 1085. I need to sell it. You are correct. I needed to hit that. Sell to open. All right. And so then Anonymous says, do you sell naked options? That's not what this presentation is about. I'm selling a put to buy a stock, and inside my book, I call that cash secured put selling. And that means that you have the capital to buy the stock, and you're approaching this as if you put a limit order in to buy the stock. Can you sell naked options? Yes. You have to have that level of approval, and that means that you don't have, most of the time, you do not have the capital to buy the underlying stock. But that's a totally different way you're going to manage that trade. You're going to adjust the trade. In this instance, if Microsoft came down to 435, I'm happy to buy the stock. That's the way that we're approaching this. And if it doesn't, and after their earnings report, the stock jumps up 20 points, oh well, I still received my premium, and in this instance, it would be $10.70. Thank you for pointing out that I had the buy to open in the wrong thing. Apologize for that. All right, I don't see any more questions. And I went a little bit over. No, I guess we're about right at this point in time. So that's it for this edition of generating income selling cash secured puts. Now I put in cash secured puts because I do think that that's an important term that should be added into the strategy. My name is Brian Overby. You can follow me on x.com. My handle is at Brian Overby, author of the Options Playbook and Options Play Senior Options Strategist. Stay tuned for more education we have coming your way inside the First Trade platform, and everything that I showed you today is available to you inside the platform. Thanks for stopping in.